Stop what you're doing. If you are sad, stop being sad because I want you to smile. Smile only if you own silver, of course. Now, I need you to look at the screen, and I need you to listen to me very carefully. While the Western financial media is trying to distract you with noise about the Fed or the latest political scandal in Washington, something titanic is shifting beneath the surface of the global economy. Something that makes the comics drain look like a rounding error. We have been tracking the whales. We have been tracking the central banks. But we forgot to track the biggest monster of them all. We forgot to track the desperate, terrified savings of 4 billion people. Ladies and gentlemen, Asian guy here, I want to give you a statistic that should keep every single person who is short silver awake at night for the rest of their lives. It is a number so large that it distorts gravity. According to the latest banking data released out of Beijing this morning, Chinese households are currently sitting on a cash pile of $22 trillion in bank deposits. Let me write that out for you. $22 trillion. That is not the government's money. That is not the corporate money. That is the mom and pop money. That is the life savings of the average Chinese citizen who has worked for 30 years to build a nest egg. And right now, that money is trapped in a burning building. You have to understand the psychology of the Chinese saver. For the last 20 years, they had a simple formula. You make money and you buy an apartment. Real estate was the god. Real estate never went down. But in 2026, that god is dead. The Chinese real estate market has collapsed. The developers are bankrupt. The apartments are unfinished. Nobody trusts the housing market anymore. So where did the money go? It went into the banks. But here's the nightmare. The People's Bank of China has slashed interest rates to emergency lows. They're offering 1% interest on deposits. Imagine having your life savings sitting in a bank earning 1% while the cost of food, the cost of energy, and the cost of living is exploding by 10% or 15% a year. You are losing money every single second you leave it there. You are being boiled alive. So this $22 trillion mountain of cash is looking for an exit. It is desperate. It is panicked. It is looking for anything that will hold its value. They can't buy houses. They don't trust the stock market, which just crashed again last week. They can't move the money out of the country because of capital controls. So what is left? What is the only asset that is liquid, that is traditional, that is culturally trusted, and that is still miraculously cheap compared to gold, silver? Now you might be thinking, okay, so they buy some silver. What is the clear's throat big deal? Us? You are missing the scale. You're trying to pour the ocean into a teacup. The entire global production of silver, every single ounce pulled out of the ground by every mine in Mexico, Peru, and Poland combined, is roughly 800 million ounces a year. At a price of $100 an ounce, that entire market is worth 80 billion. Think about that ratio. 22 trillion in cash versus 80 billion in supply. If just 1%, 1% of that Chinese cash pile decides to move into silver to escape the banking system, that is $220 billion of buying pressure. That is nearly 3 times the entire annual supply of the planet entering the market all at once. This is not a bull market. This is a hydraulic failure. You cannot force that much capital into such a tiny pipe without blowing the pipe apart. This is why the price in Shanghai is exploding. It isn't just the industrial users. It is the aunties. It is the grandmothers. It is the taxi drivers. They are waking up to the fact that their currency is dying, and they are doing what humans have done for 5,000 years. They are trading the paper for the metal. And because gold is already trading at record highs of $400-700, the average person feels priced out. They feel like they missed the boat on gold. But silver still looks like a bargain. Silver still looks like the poor man's gold. So the money is flowing down the path of least resistance. It is flowing into the white metal. This $22 trillion avalanche has started to slide. We are seeing the early tremors, and the authorities know it. They are terrified of this capital flight. They know that if the people dumped the UN for silver, the currency collapses. So what did they do overnight? Did they fix the economy? No. Did they raise interest rates? No. They attacked the market. They tried to ban the thermometer because they didn't like the temperature. We need to talk about the panic in Shanghai. We need to talk about the new order that was just issued to the Shanghai Futures Exchange banning the algorithms. Because when the government has to unplug the computers to stop the price from rising, the end is near. Let's go to Shanghai. Let's look at the desperation of the regulators. The authorities in Beijing are not stupid. They see the $22 trillion tsunami forming on the horizon just as clearly as we do. They know that if even a fraction of that capital hits the silver market, the Shanghai Futures Exchange will not just rally, it will vaporize. It will go vertical in a way that breaks every clearinghouse and bankrupts every short seller in the system. So what is their move? How do you stop a market that is being driven by the existential panic of 4 billion people? You can't stop the people. There are too many of them. So you stop the machines. We have just received intelligence confirming that the Chinese regulators have issued an emergency directive to the Shanghai Futures Exchange. They have ordered the immediate removal of high-frequency trading servers from the colocation centers. They have effectively banned the algorithms. Now they are calling this a measure to cool market sentiment. They are using polite bureaucratic language to tell the world that they are just trying to maintain orderly conditions. Do not believe them. This is not about cooling sentiment. This is about survival. This is the financial equivalent of pulling the fire alarm and cutting the power to the building because the fire is out of control. You have to understand what this means. For years, the high-frequency trading algorithms were the best friends of the central planners. The algorithms provided liquidity. They kept the spreads tight. Most importantly, they were programmed to sell into strength. They were designed to cap rallies. Whenever the price got too high, the machines would step in and short it back down. But yesterday, the machines broke. The physical buying pressure from the Chinese public and the industrial panic from the solar companies was so violent, so relentless, that the algorithms couldn't hold the line. The buying overwhelmed the selling programs. Instead of capping the price, the volatility caused the machines to switch sides. The momentum algorithm started buying too. The regulators looked at their screens and realized that their own tools had turned against them. The price was about to teleport to $200 in a single session. So they pulled the plug. They literally kicked the robots out of the exchange. This is an admission of total defeat. It is an admission that the paper-silver market in China is no longer functioning as a price discovery mechanism. If you have to turn off the computers to prevent the price from rising, then the price wants to rise. The price needs to rise. It is like holding a beach ball underwater. You can hold it down for a while, but the moment your muscles fail, the physics take over. The ban on HFT is the sound of their muscles failing. They are trying to slow down time. They are trying to buy a few more days, maybe a few more weeks, before the inevitable explosion. But here's the irony. By banning the speculators and the algorithms, they haven't solved the problem. They have made it worse. They have removed the liquidity. Now, when a solar panel manufacturer comes to the market and needs to buy 10 tons of silver to keep their factory running, there's no algorithm on the other side to sell it to them. There is no buffer. The order book is thin. The order book is empty. So that 10-ton buy order doesn't move the price by 10 cents. It moves the price by $10. They have created a vacuum where the price can gap up violently on zero volume. They have turned a controlled burn into a wildfire. And the Chinese people, the ones holding the $22 trillion, do you think they are scared by this? Do you think they look at the government banning trading and say, oh, I guess I should keep my money in the bank earning 1%? No. They look at the ban and they see blood in the water. They see a government that is losing control, and nothing, absolutely nothing, makes a population hoard real assets faster than seeing their government panic. The ban on the algorithms is the ultimate validation of the bull case. It proves that the shortage is real. It proves that the official price is a lie that can only be maintained by force. And this brings us to the disconnect. And while the Shanghai Futures Exchange is playing these games, while they are tweaking the rules and banning the bots to keep the number on the screen low, the real market has moved on. The screen price in Shanghai might say $105. The screen price in New York might say $93. But try to buy a bar. Try to walk into a dealer in Beijing or Tokyo and put cash in the counter. You will find that the price on the screen is just a suggestion. It is a fantasy. The real price, the price to actually take possession of the metal, is trading at a premium that suggests the system has already broken. I made the calls. I woke up my contacts in Asia at 3:00 in the morning to get the ground truth. And what they told me confirms that we have entered a Gresham's Law event. The good money has gone into hiding. And to get it out, you have to pay a ransom. We need to talk about the real floor. We need to talk about $120. Let's go to the dealer desks. Let's see what the street is actually paying. You need to forget everything you think you know about the price of silver based on what you see on a trading app. You need to close the tab that shows the comp spot price hovering around $86 or $93. That number is a ghost. It is a hallucination generated by a broken futures market that is trading paper contracts that will never be delivered. If you want to know the real price of silver, the price that actual human beings are paying to put actual metal into their safes, you have to get on the phone. You have to talk to the dealers who are standing on the front lines of this supply collapse. And that is exactly what I did while the rest of the Western world was sleeping. I called my contacts in Shanghai. I called the trading desks in Tokyo. And the numbers they gave me are not just higher than the spot price. They are in a different universe. In China right now, the physical floor The absolute minimum price you have to pay to get a reputable dealer to hand over a silver bar is $120 per ounce. Let me repeat that. $120. If you walk in with $90, which is supposed to be the market price, they will laugh at you. They won't even open the vault door. The dealers know that their inventory is irreplaceable. They know that once they sell that bar, they might never get another one back from the refiner. So they are pricing the metal at the replacement cost, plus a massive premium for the risk of running out. They're effectively telling the market, if you want the silver, you have to bleed for it. Oh, but if you think China is bad, look at Japan. In Japan, the currency, the yen, is imploding even faster than the yuan, and the desperation for hard assets is even more acute. My contacts in Tokyo confirmed that the street price for physical silver has hit $128 per ounce. That is a spread of nearly $40 over the official paper price in New York. Think about what that means. The spot price says silver is $86. The street price says silver is $128. That is a 50% disconnect. This is not a premium. This is a bifurcated market. We are watching two completely different assets trading under the same name. One is paper, which is abundant, printed by banks and worthless. The other is physical silver, which is scarce, hoarded by the people and skyrocketing in value. This is the textbook definition of a Gresham's Law event. For those who skipped economics class, Gresham's Law states that bad money drives out good money. When a government floods the system with bad money, like the devalued yuan, the crashing yen, or the inflated dollar, people naturally want to spend it. They want to get rid of the hot potato before it loses more value. But they hoard the good money. They hide the gold, they bury the silver, they take the real assets out of circulation because they know the real assets are the only things that will survive the crash. That is exactly what we are seeing in Asia. The $22 trillion of bad money is trying to chase the tiny supply of good money. And because the holders of the silver know this, they have effectively gone on strike. They are refusing to sell at the paper price. They are saying, if you want my silver, you have to pay me $120, and tomorrow the price will be $130. This is why the inventory at the Shanghai Gold Exchange is at critical lows. It isn't just that people are buying, it is that nobody is selling. Why would you sell a bar of silver for paper currency that yields 1% interest and is losing 10% of its purchasing power a year? It is financial. Suicide. So the ask side of the order book has vanished. The only people selling are the ones who are forced to sell. The bankrupt developers or the desperate debtors. Everyone else is holding. This hoarding behavior creates a price floor that is made of concrete. The paper price in New York can drop to $50 tomorrow due to some manipulation game, and it won't matter. The price in Shanghai will stay at $120 because the physical owners do not care what the comics says. They know what they hold. But there is one group of buyers who cannot afford to hoard. There's one group of buyers who cannot just sit on their hands and wait for the price to come down. They have to buy every single day, regardless of the price, regardless of the premium, regardless of the panic. We need to talk about the industry. We need to talk about the solar panel manufacturers who are looking at this $120 price tag and realizing that their entire business model just broke. They are the inelastic buyers, and they just signaled that they are willing to pay anything to keep the factory lights on. We have breaking news on the pricing of solar modules. We have confirmation that the inflation is being passed on to the consumer. Let's look at the solar panic. Let's explain why the factories are about to halt if they don't pay the ransom. The hoarding in Shanghai is scary for the investors, but it is catastrophic for the industrialists. While the Chinese grandmother is buying silver to protect her savings, there's a CEO in a boardroom in Shenzhen who is buying silver because his company's survival depends on it. We need to shift our focus from the investment demand to the industrial reality. Because right now, the most powerful force in the silver market isn't fear, it is physics. You cannot build a solar panel without silver paste. You cannot build an electric vehicle without silver contacts. And the companies that build the green energy infrastructure of the world are suddenly realizing that the cheap raw materials they built their business models on are gone forever. We just received a critical data point from the Chinese solar sector that confirms the inflation is moving down the supply chain. In just one single week, the last 7 days, the major Chinese solar module manufacturers have collectively raised their prices by 5%. Now, 5% might sound like a small number to a retail trader, but in the manufacturing world, where margins are razor thin and competition is brutal, a price hike of that magnitude in 7 days is an earthquake. It is an admission of panic. They are raising prices because their input costs are exploding. They are raising prices because they have to bid against the wall of cash we just talked about. They are having to pay $120 an ounce to secure the pace they need for next month's production run. And here is the statistic that explains why this is sustainable. Back in 2023, silver represented roughly 4% of the total cost of a solar panel. It was a rounding error. If silver doubled, nobody cared. But today, with the efficiency gains requiring more silver per cell, and with the price of the metal skyrocketing, silver now represents approximately 29% of the total cost of a photovoltaic module. It has become the single most critical line item on the balance sheet. The solar industry has effectively become a silver derivative. When you buy a solar panel, you're basically buying a flat sheet of glass and silver. This creates a terrifying dynamic called inelastic demand. In economics, elastic demand means that if the price goes up, people buy less. If hamburgers cost $50, you eat chicken. But inelastic demand means you buy it no matter what the price is. If you are a solar manufacturer with a contract to deliver 10,000 panels to a government project in Dubai, you cannot say silver is too expensive today. I will wait. If you wait, you default on your contract. You pay penalties. You lose your reputation. You go bankrupt. So you pay. You pay $120. You pay $150. You pay whatever the dealer asks, because the alternative is halting the factory. The alternative is sending 5,000 workers home and telling the party officials that you failed. And in China, you do not want to tell the party that you failed. So the industrial users are becoming the whales of necessity. They're absorbing the supply at any price. And this is happening exactly at the moment when the investment whales are taking the rest. The solar industry alone is consuming nearly 200 million ounces a year. That is 25% of the global supply. If they increase their stockpile by just 10% because they are scared of a shortage, that is another 20 million ounces gone. Where is it coming from? The Shanghai vaults are empty. The COMEX is being drained. It has to come from price. The price has to rise high enough to convince you, the holder of the Silver Eagle, to sell it back to them. But are you selling at $86? No. Are you selling at $100? No. So the price goes higher. This industrial panic is the floor under the market. Speculators can sell, hedge funds can short, but a factory cannot short a physical input. They have to be long. And right now, they are scrambling to get long before the $22 trillion wave hits them. And this relentless buying pressure is starting to distort the other major signal we watch. Snorts it. It's starting to break the relationship between the two kings of money. We need to talk about the gold to silver ratio. We need to talk about the biblical signal that just flashed red. Because while gold is sitting at all-time highs, silver is moving twice as fast to catch up. And let's look at the ratio. Let's see where the math says we are going by May. But the facto's panic buying silver is only half of the equation. If you want to see where the price is actually going, if you want to see the target that the algorithms are secretly programmed to hit, you have to look at the relationship between the two kings of money. You have to look at the gold to silver ratio. This is the most important chart in the world right now. It is the heartbeat of the monetary system. And as of this morning, that heartbeat just skipped a beat. We are witnessing a biblical reversion to the mean. For the last few years, the ratio has been broken. It has been sitting at 80 or 90, meaning it took 90 ounces of silver to buy 1 oz of gold. That is historically absurd. Geologically, the ratio is roughly 8.1. Historically, for thousands of years of human civilization, the ratio was fixed at 15 to 1. So when the ratio sits at 90, it is a coiled spring. It represents massive undervaluation. But something snapped in the last 48 hours, with gold hitting record highs of $4,700. The ratio has suddenly crashed below the psychological support line of 70. It is free falling, and it is targeting 50. Why is this happening? Because silver is currently moving 2 times faster than gold. This is the high beta effect. When the precious metals bull market truly heats up, gold is the steady shield, but silver is the spear. Gold moves like a battleship. Silver moves like a speedboat. The Chinese investors know this. The algorithm bands prove they know it. They know that to get the same percentage return in gold, the price would have to go to $10,000. That is hard. But for silver to double, that is easy. That is just a return to the 2011 highs adjusted for inflation. So the money is pouring into the smaller market, leveraging the move. Now let's do the math for May 2026. Let's look at the technical target that this breakdown implies. If gold stays exactly where it is at $4,700 and the ratio simply returns to its modern historical average of 30 or 40, we are looking at silver prices well over $150. But gold is not staying still. Gold is heading to $5,000 and beyond as the dollar dies. If we see $5,000 gold and the ratio snaps back to a monetary level of 20 to 1, which happens in every major currency collapse, what is the price of silver? 5,000 divided by 20 equals $250. That is the target. That is the number that the charts are screaming at us. $200 to $250 per ounce by late spring. This is not a pump. This is not hype. This is a structural repricing of the metal to match its geological scarcity and its industrial necessity. The market is realizing that you cannot have gold at 4,700 and silver at 86. It is an arbitrage that is too big to exist. Nature abhors a vacuum, and the market abhors mispricing this extreme. The gap is closing, and it is closing violently. We are watching the slingshot maneuver. Silver has been held back for decades, pulled back further and further by paper manipulation. Now the rubber band has snapped. The paper manipulators in Shanghai have been banned. The industrial users are panic buying. The rock is flying forward at supersonic speed. And this brings us to the final dangerous trap that is waiting for you today. We have talked about the $22 trillion cash pile. We have talked about the $120 floor in China. We have talked about the ratio targeting $250. But if you open your trading app right now, you might see a red candle. You might see the spot price dropping to $86 or bouncing around $93. And you might be tempted to sell. You might be tempted to think, oh, the rally is over. The price is dropping. Do not fall for it. That red number is the most dangerous lie in the financial world today. It is a trap designed to steal your position before the $22 trillion arrives. We need to wrap this up with a verdict. We need to explain why the spot price is a weapon being used against you. Let's finish this briefing. Let's tell you exactly what to do. So, here's the verdict. We have laid out the intelligence. We have shown you the wall of cash sitting in Chinese bank accounts. We have shown you the panic of the regulators banning the algorithms. We have shown you the solar factories raising prices by 5% in a single week. And we have shown you the biblical collapse of the gold to silver ratio. But despite all of this, you're going to face a test today. You're going to look at your screen and you're going to see a number that doesn't make sense. You might see $86. You might see a red candle. And the voice in your head, the voice of fear, is going to whisper, maybe it is over. Maybe I should sell. Do not listen to that voice. That price drop is not a market signal. It is a trap. It is a psychological operation designed to shake you out of your position exactly 1 second before the tsunami hits. While you're staring at $86 and worrying, the real market, the physical market, is trading at $128 in Shanghai and $128 in Tokyo. Do not let them buy your silver for $86 just so they can sell it in Beijing for $120. Do not be the liquidity for the desperate banks. The arbitrage is screaming at you. The spread is telling you the truth. The paper market is broken, and the physical market is decoupling. You have to remember the macro picture. The $22 trillion of Chinese savings has nowhere else to go. The real estate market is dead. The stock market is dangerous. The yield on cash is 1%. That money is coming. It is like water behind a cracking dam. It does not care about the daily chart. It does not care about the technical indicators. It obeys the laws of gravity. It flows to safety. And silver is the last lifeboat left in the harbor that is still affordable. The central banks have made their choice. They have chosen the printer. They have chosen inflation. They have chosen to sacrifice the currency to save the system. That means the value of your paper money is going to zero. It is a mathematical certainty. So why would you trade your silver, the only thing that cannot be printed, back into the paper that is burning? It makes no sense. We are in the end game of the great wealth transfer. The volatility you are seeing is not a sign of a top. It is the turbulence of a rocket breaking the atmosphere. Do not let the shaking scare you. Tighten your grip. Ignore the noise. Look at the physical floor. The East is buying. The industry is buying. The whales are buying. The only person selling is the fool. Don't be the fool. This is John A.G. The wall of cash is here. The printers are running hot. Pulled heart.